Hey folks, welcome back to the channel. In 2023, many experts had predicted that US is heading into a recession. Many feared the downturn could be as severe as 2008 crisis. If you were to read the news headlines today in 2024, it's still the same. But what happened in 2023? That was quite the opposite. The US market actually went up and almost by 24%. If you are someone who missed investing during those lows, you might be thinking if it's the right time to invest now, if you're too late in the whole investing game. The short answer is no. You've not missed out on any bull run. There's always opportunity to invest in the stock market. The bigger question is, what is the right time to invest? To help you make that decision, let's look at the three major factors that are playing in the US market right now. Let's look at the economic situation in US. Let's look at the valuation of the stock market and finally the political outlook for this year. Before I jump into these three factors, let me tell you this is not a stock recommendation video. It's an analysis video to help explain my reasons for investing in the US market. Let's look at the economic factors, the inflation, interest rates, and consumer spending. Inflation was at its highest in June 2022 in the US. It was roughly 9%. So the government had increased the interest rates. It's one of the most common techniques used by the central banks across the world. However, the interest rates, which were around 0% during the pandemic, had gone up to almost 5.5%, which is steep. Imagine how deeply it would have impacted someone who took a home loan when the interest rates were close to 1% and then it shot up to 7-8%. Their EMI went up, their cost of living was anyway high because of the inflation, and so that would have impacted their savings hugely. And that's why the experts had predicted that the growth would slow down. But that's not what really happened. Consumer spending was in fact high. In the third quarter, the GDP growth rate for US was 4.9%. Now that's phenomenal because most analysts had predicted that US was heading into a recession, which means that the growth rate needs to be negative. It wasn't just that US had avoided recession, it didn't even slow down. It was doing quite well. The inflation had come down roughly 3% from the highs of 9%. Unemployment rate is modest, around 3.7%. Anything below 5% is good. And stock markets have seen a massive rally. Now, the natural question that you would have is, that's good to know about 2023, but what does that mean for 2024? Now, I'm not an economic expert, so I do not know what's going to happen, but here are some facts for you. Number one, Fed in December had indicated that there will be 3 rate cuts in this year. That's not guaranteed. It's only an indication, which means if the inflation had to go back up to those 7, 8, 9% levels, then there is a chance that there could be another rate hike instead of a rate cut. However, it seems very unlikely at this stage, considering it's an election year. And another rate hike could hurt the chances of the Biden government to come back into power. Also, the inflation has come down significantly. And there are hopes that it would come down further without the need for any further rate hikes. So what really happens when there is a rate cut? Well, to explain you very simply, there's more credit available. The supply of money in the economy increases. People refinance their home loan, take more credit, either spend more on their credit cards, try to get other personal finance options that they have, and the consumer spending in general goes up. You might be thinking, will the stock markets go up because of all this? It might, but it seems to have been factored into that 24% rally already. Let me explain. So some smart investors, especially the big ones, the FIIs, the government institutions, the BlackRocks of the world, they saw that the inflation was coming down. People were spending more and the whole economy was on the upswing. So they already had in mind that the interest rates would drop in the next year. What happened was that the stock markets went up in the anticipation of what is going to happen. Think of stock markets like a mirror, like a future mirror. It shows you what the investors as a collective are thinking. And to help explain, let me now come to my second factor, which is the market valuation. So let's look at the earnings, the PE ratio, and the overall valuation of the market. So to understand the US market valuation, I'm heading to this website, Simply Wall Street, and it collects data from roughly 9,000 plus companies and it aggregates them at the market level to provide us with this synopsis. What I'm going to look at is this chart here, which talks about the PE ratio. So if I were to look at the PE ratio as of today, it's around 28.2x. And if you look at the 1 year average, then that 1 year average is 26.9. So slightly above the 1 year average. However, it's all right. It's not that bad. What I particularly like about this graph is that it also gives you 3 other parameters. So you can look into the total market capitalization, you can look at the total earnings, and you can look at the total revenue. So this graph is really interactive, so you can actually see how the earnings, the revenues, and the market cap has trended over a 1 year period. And you can also then, look at the various periods. I'm really interested in the 10-year period because that gives you a really good insight into what happens. So let's look at how the revenues and earnings have played out since pandemic. The revenues, especially at this juncture. So the revenues kind of have remained flat, more or less, okay? There is a slight increase, but then it's roughly, in that 20s range. So even if you look at, the numbers, it's 15.8 trillion in June 2020. It's approximately 15.4 trillion in October 2020. It's 15.6 trillion in Jan 2021. So it's remained stable. However, what has happened is that the earnings have gone down significantly. So from the peak of 1.3 trillion, the earnings had gone down to almost 840 billion. So that's a huge dip right there. And if you look at the market cap at that particular time, the market cap had actually gone up. And why is and even look at the PE ratio at that point. So the PE ratio was actually quite high. It was roughly 45 times. Yeah, the price was 45 times the earnings. So what is really happening? The earnings are going down, the revenues have stayed flat, and the market cap is actually going up. So if you look at the graphs, which is in the 2021 period, what has happened? In 2021, basically, what the markets were predicting was that the earnings are gonna go up. And that is exactly what has happened. In 2021, the earnings have gone up quite a bit. So from $800 odd billion, the earnings have shot up to almost $2 trillion. And that is the reason why the markets were up in 2021. The market PE was 52 times the earnings, the forward earnings. So the market had already predicted that the earnings in 2021 are gonna go up because of the whole pandemic. 2020 was a bad year. The companies were not making as much profit as they should ideally. And when things started to look a little better, things started opening up, that's when earnings started increasing as well. But this was already factored in the markets, because if you look at the market valuation is going up, really up. So this red line in here, that shows us that the market valuation was quite high at that point in time. And you can really find many such examples where the valuation is not in sync with the earnings at the time. You might have some questions as to what's going to happen now in 2024. And this is where we are. Currently, because the P ratio is flat, like it's really that 10-year average of 29 something, I really don't see that the market is undervalued or overvalued. It is quite right in the way the valuation is.
And that's the reason why I will not be investing at this moment.
All right. Now that we have looked at the economic outlook, we've looked at the market valuation, the last factor that we need to look at is the political outlook. Look, I'm no expert on the US politics, but here's what we do know. Number one is the fact that it's an election year. So Biden is running for the second term, whereas Trump is fighting the legal battle to still stay in the presidential race. It's a big year for US. US is very polarized. We all know that the 2024 elections will decide what the next 4 years will look like. Both Biden and Trump administration have such a huge difference in their policies, in the way they execute things, and the overall approach to governance. Who wins, you would think that might really have an impact on the stock markets. But research suggests that there is negligible impact on the US stock markets. It's really not based on the president or the party that comes into power. And even if there is certain euphoria which builds up and then that's reflected in the stock market, usually that's temporary and that wouldn't last long. What matters though is the kind of policies which are pursued by the party that comes in power. What their stance is on climate change, the trade relations it has with other countries, especially China, and what happens if China attacks Taiwan. This will have a major impact, not just on US, but on economies across the world. So based on all this, should you or should you not invest in the US markets? I can't tell you what you should do, but here's what I can tell you. I am heavily invested in the US market. Close to 50% of my portfolio is invested in the US stocks and ETFs. I have bought shares as well as ETFs in Nasdaq, especially in the technology sector, and also in S&P 500. I did most of my investments starting 2022. Most of these are for long term. I will hold on to these for a good 10 years at least. Whenever I have opportunities, I will look to invest more. Whether I will invest in 2024, yes, I will when there's a good opportunity for a good stock. However, what I'm not going to do is buy the index ETFs. So I'm not going to build my positions further in Nasdaq and S&P 500. I have done that. I will wait for a correction to happen, and when there is a good margin of safety, I will be investing in these indices.